Welcome to Talk Tickers. Today, we are digging into industrial manufacturer Atkore and the absolute chaos that followed its third quarter earnings report. Let's get right into it.
So, picture this, August 5th, 2025. This is what investors woke up to. Atkore's stock didn't just dip, it literally fell off a cliff. We're talking over a quarter of its value gone in one single day. A brutal, shocking collapse. And here's the real head-scratcher. The big headline number, the one everyone was watching, it was actually good. They beat their earnings estimate. So what on earth happened? How does a beat turn into a bloodbath? Okay, so let's start with the good news, because honestly, on the surface, everything looked pretty solid. This is the part of the story that makes that 26% drop so confusing at first. All right, let's look at the actual numbers. The street was expecting 1.58 for adjusted earnings per share. Atkore comes in at 1.63. That's a solid 3% beat. In any normal world, that's a positive surprise. Investors should have been pretty happy, right? And get this, it gets even better. Management felt so good about things, they actually raised their forecast for the full year. They bumped up their guidance. So you've got an earnings beat and a raised forecast. That's the classic recipe for a stock to go to the moon. So that just brings us right back to the big question, doesn't it? A beat and a raise should equal a big win. But for Atkore, it led to an absolute crash. To figure out why, we've got to dig deeper, way past the headlines. See? That headline number, the earnings per share, it's really only one piece of the puzzle. To see the full picture, you have to peel back the layers. And that's where we find all the negative signals that were lurking just under the surface. Okay, so here's where the story starts to turn. First, their revenue, it just barely missed estimates. But, and this is a big but, it was down almost 11% from last year. And then you get to the real bombshell, adjusted EBITDA. That's a key number for a company's core profitability, right? Well, it got cut in half. It plunged more than 51% compared to last year. Ouch. And this chart right here, this shows you the root of the problem. It's the collapse in their gross margin. Think of it this way. A year ago, for every dollar they sold, they got to keep 34 cents in profit. This quarter, just over 23 cents. That is a massive drop in how much money they're making on each sale. So what happened? Why did their profits fall off a cliff like that? Well, it all comes down to something called pricing compression. All that really means is they couldn't charge as much for their stuff anymore. They were being forced to lower prices, especially on their PVC and steel products, and that just absolutely crushed their profitability. All right, so the financial picture is looking pretty grim, but just when you think it can't get any weirder, management throws a total curveball. And this one had nothing to do with the numbers, and everything to do with the person in charge. On the exact same day as this chaotic earnings report, the CEO, Bill Waltz, a guy who'd been there for 12 years, just up and announces he's retiring, effective immediately. The timing was just stunning, to say the least. And here's why that is such a big deal. The market absolutely hates uncertainty. It's like the captain of a ship announcing he's jumping overboard right as you sail into a hurricane. It's a huge red flag for investors. Who's steering the ship now? So let's recap. We've got shrinking profits and a sudden leadership vacuum. The last nail in the coffin? It came from management's own forecast. They basically warned everyone that the pain was far from over. And they didn't just hint at it, they put a big, scary number on it. $50 million. That's the headwind they're forecasting for the next fiscal year. A number like that tells the market, yeah, these problems, they're sticking around. So where's that $50 million hit coming from? Well, surprise, surprise, it's the same old story. They expect prices on their PVC products to stay low, and on top of that, they're getting hit with new tariffs on aluminum, which makes their costs go up. It's the ultimate double whammy. Sell for less, pay more to make it. Okay, so let's put it all together. You've got the fake-out earnings beat, the brutal margin collapse, a surprise CEO exit, and a warning of more trouble ahead. It's time to put on our analyst hat. What's our call? What happens next? All right, here's the next call. First, for the next quarter, Q4, they'll probably hit their numbers. But honestly, who cares? All eyes are going to be on that 2026 forecast. Second, the stock itself, it's going to be in the penalty box for a while, at least until they name a new CEO who can come in with a believable plan to fix this margin mess. So with all that uncertainty, our final rating has to be underperform.
At the end of the day, Atkore's story is a perfect example of why you can't just look at the headline number. The company's got two huge mountains to climb now: fix its collapsing profitability and find a new leader. It all boils down to one question. With a new captain needed to navigate this storm, can Atkore possibly rebuild everything that was lost in just a single day?
And just a reminder, this is not financial advice. We're just breaking down the numbers for you.